workers and families for decades, they can join Democrats in the fight to raise wages, to
Senate
lower
banking,
the cost
where
of
Jay Powell's Q&A is about to begin.
More affordable, to pass the American Jobs Plan. Of course, most of them won't say aloud what all this inflation alarmism is really all about. It's simply they don't want workers to have more power. In reality, the biggest risk to our economy, Mr. Chairman, is not doing enough to empower workers and not doing enough to curb Wall Street greed and excess. Chair Powell, my question is, you've supported Vice Chair Quarles as the Vice Chair of Supervision, his efforts to weaken capital requirements at the largest banks through revisions to the stress capital buffer, and you oversaw weakened CCAR stress tests, which ultimately decide how leveraged the biggest banks are. Governor Brainerd has pushed back against your efforts to weaken financial regulations. President Rosengren of the Boston Fed made the case that strong financial regulation enables the Fed to be more aggressive in its full employment mandate. President Mester of the Cleveland Fed, President Kashkari of the Minneapolis Fed are outspoken on the need for the board to keep its eye on financial stability. Weakening financial safeguards doesn't help working families. It just increases the risk of a financial crisis, wiping out everything they've worked so hard for. We're finally making progress, as I said earlier, and workers are getting a better seat at the table. We can make the economy safer and fairer with higher capital requirements of the biggest banks. My question, Mr. Chair, is why have you been against stronger capital requirements and using the countercyclical capital buffer in curbing runaway executive bonuses and stock buybacks?
So I guess I would say with the stress tests, the severity of the stress tests has very much been maintained. The effect of the stress capital buffer overall was to raise capital requirements for the largest firms, and they did manage to get through the recent pandemic and the acute phase of it and the recovery, and did their jobs during so I think that by and large our financial institutions are well capitalized. We limited their distributions during the pandemic, and their capital levels actually rose quite materially during the course of the pandemic. So the financial system is strong and the banks are strong. I have felt, and I've said on a number of occasions, that the level of loss-absorbing capital in the system is about right. I think the experience of the pandemic bears that out. I would be prepared to deploy the countercyclical capital buffer if I thought that the conditions we laid out were triggered, but I haven't so far felt that way.
Shepard Smith here. Thanks for watching CNBC on YouTube.